Hey everybody, David and Belinda here today. We are beating a dead horse again, talking about what it means when interest rates raise and home prices drop, and why everybody's waiting for something to happen in the real estate market for them to have the opportune time to get themselves in. So I'm going to run down two scenarios here. Belinda's going to stop me if I am playing outside of my sandbox because I am not a lender, but I know enough to be dangerous and convey this to my people out here. So our first scenario here, it's a $500,000 home. They put 5% down, so $475 carry on the balance for their loan. This is at 6%, and we want to keep in mind that percentage because a lot of people are expecting home prices to drop, and that's when they're going to get in the market because that's the best opportunity for them. Here we have another scenario. This is a $400,000 house, so this is reflecting a 20% price drop from that $500,000, but our interest rate increased by 1%. Doesn't seem like very much, but let's see how this affects things. So our monthly principal and interest payment for the $500,000 home at 6% comes out to about $2,800 a month. The interest paid over 10 years on this loan specifically is about $264,000. If we jump down to our $400,000 home at 7%, it actually comes out to $2,464 a month. So a little bit lower of a monthly payment by about $400. The yearly discrepancy between the two is $4,500 a month or per year. And so when we're looking at this, we also want to keep in mind that home prices are still going up, even though they're pulling back. On the grand scheme of the trend, we're still in an upward direction. And so if we take a very conservative 4% appreciation on the $500,000, that's going to give us $20,000 in equity. Whereas the $400,000, if we were to see that same 4%, it's only $16,000 for the year. So right there, you wipe out the discrepancy between the two monthly payments just by having the higher valued asset. And you can kind of see the difference between how much is paid in interest between the two. There is a little bit of a discrepancy there, but that 1% interest point does kind of wipe out any sort of savings that you would have made just by waiting to get into the market regardless. And so the theme of today is that interest rates are going to fluctuate. It's a cyclical business like Belinda talks about all the time. And I just kind of want you to give us some insight because you've been doing this long enough. Most people's hang-up are these redundant figures and
they want lower prices on the sales price and they want lower interest rates. What we need to realize right now in the current market, values aren't increasing like they were, but they are still increasing. Mm-hmm. Interest rates are increasing. So when is the time to buy? Now, while this is still going up, next year you have equity and the rates could go up. So trying to make sense of it, the time to buy is the time you're ready and now. You'll probably pay more, a little bit more for a house next year and rates could be higher. When are rates going to come down? Well, if I had that answer, I'd be rich living on the beach drinking Mai Tais, I promise.
Well, that's it for it. I mean, it's kind of these are the scenarios that hang people up. And so the first step really is sitting down with somebody like Belinda, figuring out your financials and seeing where you can just start getting started. And it's always the first home that's the hardest.
Yeah.
From there,
it's free to talk, guys. It doesn't cost a dime and you can figure out how, what, when, and where you're going to go.
I love it. Well, thank you, Belinda. Let her know if you have any questions. Reach out to me. I can get you connected with Belinda here. If you have any questions, she's a personal finance background, gone lender, and has all of the financial intuition that we need to get you on the path to success. So let us know if you have any questions. See you next time.
Thank you.